All right, so let's take a look. I'm using the mortgage calculator that's on my website. I really like this calculator a lot. It's pretty neat. It has basically everything you would want in a calculator, and I'm linking to it in the description. And if you need any help figuring things out, just let me know. I'll help you use it. But you can mess around with it as much as you want. So let's say you're pre-approved to buy a $750,000 home, which is about the median home price in Santa Clarita right now. You've got 10% down. Let's say you've saved money. Maybe you've got a retirement plan that you've borrowed some against, uh, basically borrowing from yourself. And maybe you're going to get married and your parents offered to give you money instead of a fancy wedding. And, these are just examples of typical down payment fund sources that we see, especially for first time buyers. So you're looking at a $675,000 loan amount. Let's get that interest rate up. Whoop. Yeah, keep going, keep going. Ooh, yeah, we're 6.95 right now, about, if you get a really good rate. Uh, Property tax, count on about 1.2% of the purchase price, the value. Mortgage insurance, PMI, you're going to have to pay that if you don't have 20% down. That represents about $500 a month in this case, but after 99 payments, it'll go away. And chances are you'll actually be able to get rid of it way before then. And you can't forget homeowners insurance, which is about $1,500 a year. So you are looking at about, this should be 9,000. My bad. 58, 38, 15. So that might be a tough pill to swallow. Uh, I'm sure it's more than you're paying in rent right now, but real estate's a long-term game. But let's, maybe you say, okay, I just need to wait for rates to come down. That's just not affordable enough for me. All right, cool. Let's take a look at that. Keep in mind that for every percent of interest rate change, you're looking at about a 10% change in affordability and buying power. So if rates go down 1%, buying power goes up 10%. And chances are all the other buyers are going to have the same idea and they're going to be able to pay more for the same house because they can afford to. So that's going to drive prices up. So that $750,000 house, let's say it's now cost $800,000, and you've got your 10% down, but you've got your 5.95% rate. You're going to pay a little bit more in property tax because your basis is higher, and you still have the PMI because you're not at 80% loan to value. So you're looking at 57.38. All right, you've saved $100. Awesome. However, don't overlook the fact that you missed out on $50,000 of equity growth to save that $100. Now I get it. $100 a month, can make a big difference, especially if you have your set budget. But you got to take that equity growth into account. Now let's say you bought that $750,000 house at 6.95%, but now the property has gone up in value. Let's say it's at 825,000, and you've paid the mortgage down. So now you're at 80% loan to value ratio, and you decide you want to refinance because rates came down. So now you can refinance into that 5.95% rate. Your property tax, 9,000 because you bought when it was 750. And look, because you're at 80% LTV, your PMI went away. Now you're looking at $4,800 a month. Now you're saving $1,000 a month because you didn't wait for something to happen before you made a move. You bought when you could, and then you took advantage of what the market gave you because you were already in and you were ready for it. Meanwhile, everybody else was waiting for that thing to happen, and they're 2, 3 steps behind, and you're ahead of the game. Meanwhile, your housing affordability is only going to keep increasing because you're locked in. And if rates drop even further, you can refinance again and keep dropping that cost of your housing, as long as rates go down. So it doesn't make sense to wait, in my opinion.